We're going to kick things off with our first speaker, Catherine Malone. Catherine is the Director of Insurance Sales Enablement at Sun Life. Her session is a fresh look at UL and staying ahead of the pack. Expect to learn how UL can be positioned for your business owners and why it remains a flexible, relevant solution. Catherine, welcome to the virtual stage. We're excited to hear your perspective.
Appreciate the opportunity to be here and chat with all of you today. I think we mentioned we'll have a little bit of time at the end if there's any questions. Happy to help out in any way with more information. All right, so let's dive into it. So just starting off, we wanted to take a step back and take a look at the biggest global industries by revenue. Some of these were not surprising to me really at all. The car and automobile sales, real estate, of course, pension funds. But the one thing that kind of was really surprising to me actually is that the life and health insurance carriers actually have the biggest revenue globally, which I mean, understanding that we are supplying products and services to many individuals across the globe, but it is a large industry. It is an important industry. We are providing products and services to very high net worth individuals as well as your everyday family, type of individuals. So we really are diversified across all of the different types of clients who are looking for protection and for being able to manage their finances long term. When we take a look at our non-par perm cases, so we are number one in the perm or the par industry, but we're going to focus more on the non-par products today. So we wanted to just share with you some of the top cases that we've had in our non-par perm space. So that would include some like universal life and as well non-par permanent insurance. All of our top 10 cases in the non-par perm space were with Sun Universal Life, and we're seeing that used with the YRT structure. We don't have a YRT 100 product available directly off our shelf, but we do special quote it, and all 10 of these cases were using that YRT 100 structure, all of in corporate situation and all through our MGA channel. So we did see some fairly significant premium, looking at that top case there with 50 million in face amount and 4.2 million in premium. So we are seeing the high net worth business owners in particular who are looking at this product to be the right solution, and as opposed to par. And not to put par down in any way. Par is a wonderful product, but it is not necessarily the right product for every single case. So here's where we want to shed a little bit of light on that, the Sun Universal Life and where it can really fit for the right client. So we'll take a step back in history a little bit, and this is not to really reminisce the past, but it's more to understand like why the sentiment towards UL is where it is today. We've seen a lot of the business sort of merge towards that par space and seeing less interest in the universal life. So just want to quickly go through why we believe that is the case. Obviously, in the 70s, there was a very different economic environment. We were looking at increasing tax rates, high inflation, rising interest rates. Par was viewed more unattractively then because they felt that they could get better rates with a universal life type of product that had different types of investment vehicles that they could invest in within the product. At the time, there was no universal life, so they were looking at a T100 with an accumulation fund type of product, and this is where universal life was born from. If we skip ahead a little bit and we look in the 90s and the 2000s, the rates used for pricing universal life were at about 7%. Where if we look at today, because of the declining interest rate environment, that's dropped to around 2%. So the money that we're earning on the premiums that are paid is significantly less than what it was back in the 90s and 2000s. Also, there was minimum rate guarantees of 4%, which included a 1% investment bonus, back in the 90s. And today, that's typically zero. There might be some that have a 1% guarantee, but that's not the norm industry-wide. And then surrender charges were able to be used to inflate and boost the tax exempt room. And those rules were all changed in 2017 with the new tax rules that came in. So those surrender charges don't really contribute to creating that boost in exempt room. Biggest thing I would say is back in the 90s, sort of the 8 to 9% was that default illustrated rate, which really showed, some great returns and great growth within a product over time. And now, given the interest rate environment, we wouldn't recommend illustrating too much more than 3 if you're wanting to be fairly conservative. So that really changes how the product, appears to clients, and especially if you're in a comparison with participating insurance. But we want to go through today and show, how it can still really be a strong performer, even compared to par. And this is just illustrating, this is sort of industry mix within Canada for the last, 20, 35 years or so, where, in that 2000 range, we were really seeing UL as this very strong performer, even, far more preferred over par. The last, 12 to 13 years or so, we've seen par really take off and be that market leader in performance. But we are starting to see a revival in Universal Life. Even at Sun Life in particular, I would say the last year or so, we've really seen some strong Universal Life sales, and that is in particular in that high net worth business owner market, where this can really be a strong solution for estate planning. And why are we seeing sort of that trend? Well, we look at the Government of Canada 10-year bond. We've seen it continually declining, over the last 30 to 40 years. There was a bit of a jump up after COVID. It's kind of leveled off a little bit again. We'll have to wait and see, I guess, to see if it's going to continue to increase or sort of remain at this level that it's at. But that has, caused a lot of issues with pricing on the Universal Life side, where you've probably seen most carriers in the industry reprice their cost of insurance structures a number of times over the last 10 to 12 years. Just because it doesn't look exactly like it did in the 80s doesn't mean it's still not a great product. It has its opportunities for where it fits better than a lot of other products. So what does that mean in terms of how the pricing works? So obviously with a YRT, typically the client is paying more in the early years than what the actual mortality charges are. And then there's sort of this crossover point at some point where, given that they're, typically are overfunding in those early years, it's going to be able to carry them for the rest of the life of the policy. But you see those YRT charges really kind of ramp up in the later years because it's based on the client's age every year. So, typically your deposits in later years are going to be less than what the mortality charges are, and in the early years it's going to be greater. And that really will depend on the interest rate and what they're actually earning within their policy for how long they're going to have to pay. So typically, when we were looking at that last chart where we were pricing with earning a 7% return many years ago, we changed that now to only earning 2%. You can see how that pushes out how much longer the clients are going to have to overfund in those early years, because that cost has changed, given that we're not earning the same percentage that we were many years ago. And typically, we're going to say for every 1% drop in interest rates, it's approximately a 10% increase in cost of insurance. So it's going to push that out. So, using the right interest rates assumptions within your illustrations is really going to set the expectation appropriately with clients. I think industry-wide, there were some blocks of business from many years ago that were illustrated at 9, 10, I've even seen 11 and 12% returns. If those returns don't materialize, and if clients aren't managing their policy along, with your collaboration well, they can end up in a position where later on in, their life or the life of the policy, they're going to be in a position where they may have to start to pay cost of insurance again. And this likely isn't how it was illustrated to a client. So I know there's some sentiment out there that it's difficult to position universal life when you had that kind of experience in the past. But I think given the, how we're structuring the defaults and illustrations today industry wide, no one is really illustrating at those higher interest rates. So setting that conservative expectation upfront can really manage the policy long term and make sure that it's going to meet the client's needs exactly the way they expected it to. So I talked a little bit about the pricing changes that had to occur because of the declining interest rates. So if we look at sort of the limited pay period, so 10 pay and 20 pay, 10 pay was more affected, I would say, than any other cost of insurance structure. Cost of insurance have increased by about 70% since 2010, and then 20 pay about 30%, so not quite as significant. Level increased about 50%, but we're really seeing some interesting activities in the YRT space. Most of the industry sales are in that YRT space, and I'll show that in just a second, but we've seen those costs of insurance actually decline by about 50% on average. And there's a sort of renewed interest in this YRT space, given that those costs are more affordable and that clients can really structure it in a way that fits for their needs. So if we look industry-wide, universal life sales are kind of, we're on the decline a little bit before COVID. We did see a jump after that, and I think a lot of that has to do with the flexibility of the product, where clients can take, premium holidays and have a lot more flexibility within the plan itself. So we have seen some renewed interest in it in the last, few years. But if we break that down by the actual cost of insurance type, limited pay has just been on a steady decline for the last number of years. And I think, people are starting to see, and clients are starting to realize, and, advisors face as well, that YRT really has the greatest amount of flexibility in it. With a limited pay, you're going to pay the highest cost of insurance, of course, because you're paying for that guarantee of not having to pay premiums afterwards. But you really can structure a YRT to sort of mimic a limited pay. And we'll go through some examples in a few minutes. For the YRT sales themselves, there are two carriers in the industry that sort of dominate in this space, and they have a very different distribution structure to most other carriers, where they have a lot of advisors who are sort of working part-time and mainly focused on just selling YRT UL. So they do sell a lot of very small policies, sort of in that family market space. And then the other carriers, which would make up those yellow bars on the right, kind of make up about half of the amount of sales that the top two do. But that's more in that higher net worth space, I would say, where they're selling less policies but higher face amounts typically to that business owner, high net worth space. So it's just a bit of a history. So we'll go through today why universal life, and we'll go through a couple of case studies that will give you, real life examples of where universal life really fits and can be a great solution for the right client. So just step back and do sort of a product 101 for a second here. So the transparency of universal life has always been one of the key factors that clients and advisors really like. So PAR tends to be more of a black box. How are the dividends calculated? All of that is not really communicated widely by carriers, but universal life is very transparent. So client pays a payment. We are going to subtract the premium tax, which will vary depending on the province that you're in, and that will equal your net payment. And that net payment goes into the policy fund. And then from there, we're going to take the monthly cost of insurance, if there's any expense charges, which would typically be included in that cost of insurance, and we would pay death benefits from the policy fund. So very clear on where exactly that money is going and what it's being used for. And then, of course, with universal life, clients have the opportunity to pay more than their cost of insurance, and they are able to pay an amount up to what CRA dictates as an exempt line. So that means anything under that exempt line, they're going to be able to invest within the policy and earn interest on a tax preferred basis. They can choose to pay more than that amount, though, and once they do that, once it exceeds that exempt limit, it's going to get kicked out into the service account, which they can also choose to invest in various investments within the service account, but they are going to pay interest on whatever uh, whatever growth they occur within the service account. As room becomes available within the policy fund in that exempt room, payments get pulled back from the service account, but keep in mind that they have to pay premium tax again once it comes back in. So typically you're not wanting to set it up to have a lot of back and forth activity between the service account. If you can keep it within that exempt sort of limit, it's typically going to be the best way to structure that for a client. Talked about premium flexibility. Obviously, the impact of COVID-19 had a huge impact on small businesses. Obviously, they were worried about not being able to be viable business, whether they were going to have sales dropping, whether they were going to be able to take on more debt. So most business owners at that time were obviously very concerned about the viability of the future of their business. And we found that, speaking with advisors, speaking with clients through that time, that the clients who had universal life policies were so grateful for the premium flexibility that they had within the product, particularly those who had maybe made an overfunding situation in the past. It gave them that opportunity to take a premium holiday if they needed to be able to keep their money going into their business. Obviously, no one would like to see a COVID-19 situation again, but there's many businesses that have fluctuations in cash flows, even just due to seasonality. So the flexibility within a universal life plan really fits well within that business space to be able to afford clients to be able to structure it to the ebbs and flows of their own business. So we did a comparison between PAR and UL in terms of what would it look like to be able to take some of those premium holidays. So if we are looking at the top rows here, Sun Universal Life, the guaranteed 10 pay after one deposit, they still can't take a premium holiday, and nor can they after two deposits. So this is really showing that those guaranteed 10 pay are great for the right client who really want the ultimate in guarantees, but having some of the YRT structure can give them that different flexibility that they can't get with those guaranteed deposits. So if we look at the YRT 85, we looked at a couple different interest rates, which didn't really change the outcome. But after one deposit, and this was, I think they were depositing $100,000. It was for a 60-year-old male to see what that would look like. So they did 100,000 deposits for 10 years. But after we look at one deposit on the Sun UL 85, they can take a 4-year premium holiday. And after two deposits, they could take 7-year premium holiday. So that just shows like they could make one payment and then have the flexibility within the next number of years they can certainly continue paying, which just would increase the amount of holiday that they could take later on if they needed to. Or they could take, a holiday for a year, or they could take it up to 4 years after one deposit. So a lot of flexibility within the YRT universal life plans. If we take a look at PAR, though, given that it's more guaranteed in nature in terms of the 10 pay, they again can't take any premium holidays after making one deposit. And on a life pay at current -1, they can only take a holiday after they've made two deposits. And the difference as well with PAR is that they're not really taking a holiday. They're taking an automatic premium loan to cover that payment. So now there's a loan on their policy that's going to be deducted from the death benefit or the cash value later on. So a lot less flexibility with PAR in terms of being able to take those holidays, if that's a differentiator, and what can actually make the choice for the client. If we look at the most popular payment structure, 10 pay across the board, I would say, is how the universal life product is sold. Clients don't typically want to be locked in to have to pay for life, so it is often set up, whether it's through a YRT structure or a level structure, where clients are not paying for any more than 10 years. Do the payments need to be guaranteed, though? And I understand that that stability and that guaranteed nature is really important to some clients, but they may be giving up an opportunity by not looking into a YRT structure that can be structured almost like it's guaranteed. So we'll take a look at that as well. This is just showing, obviously the cost of insurance for a $1 million universal life plan on a male non-smoker who's 50 years old. That green line there at the top is going to be your guaranteed 10 pay. No surprise there that that would be the most expensive cost of insurance because it's the shortest guaranteed payment period. And then your 15 and 20 pay and level kind of, going down the line in terms of cost getting less with each option. Your YRT structures, as we saw earlier, in the early years are going to be quite a bit less than what you would see with any of the other cost of insurance options, but there will be that crossover point where it's going to really increase in those later years given the older ages. So you want to be able, with a YRT rate, you're typically not going to be minimum funding every year, because you're going to see those huge costs in the later years. So you want in those early years to be paying more than what the cost of insurance is, so that you can set it up in a way that, if the client is looking for that sort of 10 pay scenario, you want to pay that higher cost in the early years so that they can cover the mortality costs on the tail end. So we wanted to look at what rate of return would a client need to earn on the excess cash. So if they're doing that overfunding in a YRT scenario, what rate of return would they need on that so that they could pay less than the guaranteed 10 pay cost of insurance? And we've called that our hurdle rate. And to be honest, it's a lot less than what you might expect it to be. So here we just compared that and we solved for what rate the excess cash would need to earn in order to beat that guaranteed 10 pay premium. In this case, it's that same client scenario for a male non-smoker age 50 for $1 million. The guaranteed 10 pay annual premium was about $41,000 a year. And so we looked at all of the other cost of insurance options and what they would need to earn in order to beat that 41,000. So you're guaranteed 15 pay, you're looking at about 1.5%, guaranteed 20 pay, but just under 3%, your level just over 2%, and your YRT 85 just over 1%. But your YRT 70, you would only have to earn 0.1% on that excess cash in order to beat that guaranteed 10 pay premium and only have to pay for 10 years. So really a lot less than what you would think. And you take a look at the Sun Life Diversified account, and we'll dip into that in a minute. But it's an account that is available within our Sun Universal Life portfolio that mimics a PAR account. So it's all the same asset classes within it. And currently it is crediting 4.1%. So it's earning significantly more than what you would need to earn on a YRT 70 to get you to that sort of guaranteed 10 pay premium. As well, if clients are interested in more market-based funds, we compared an average return of a TSX type of portfolio at about 5.5%. Again, earning significantly more than what you would need to get you to that point where you're beating that 10 pay guaranteed premium. So you don't need to be illustrating at really high interest rates. You could be very conservative and still be in a position where clients can set up a policy that's going to meet that need or that want of having a 10 pay scenario, and not be in a position where you're likely to see the interest earned on it not meeting what your expectations were. So then we did the same thing and just looked across various ages to see if that was true everywhere that we looked. And so if we're looking at sort of under age 55, the YRT 70 is going to give you that lowest hurdle rate. But then once you get to age 55, the YRT 85 actually starts to perform better. And that's just because there's a longer time frame to how long the cost of insurance is charged. But you're looking at age 70 here, the policy could actually be in a negative state of return for the life of the 10 payments, and it would still be less expensive than what you would see with a guaranteed 10 pay. So, really good options here to consider. You want to look at that YRT 70 if you're under age 55, and the YRT age 85 would be more for those older ages, just given the longer time horizon for the payments. So that's kind of a general rule of thumb if you're looking into universal life and the YRT. So we wanted to look at the flip side. So we looked at the winners from each of the ages from the previous slide, and looked at, given a level of return in the policy, they could deposit less money into the policy as compared to the guaranteed 10 pay to keep the policy in force. So if, like I said, if we chose the winner from each of the groups and the guaranteed 10 pay policy to achieve a 2% fund return, then the client could deposit 15% less. And going down the line, so if they assumed a growth rate or they achieved a growth rate of 4%, they are going to be able to deposit 33% less. And all the way up to 5%, where they could deposit nearly 40% less than what they would have to be paying with the guaranteed 10 pay. So it doesn't mean that they need to deposit less. They could still deposit the exact same amount. That would just provide greater growth within their policy. But again, you'd want to watch that exempt line to make sure you're not pushing funds into the service account and kind of have that back and forth. So you want to sort of find that golden space where you're staying within the exempt fund, but getting the most cost-effective structure for the client. And depositing less may be an option depending on what they are investing in. We have many different funds available within the Sun Universal Life platform. The Sun Life Diversified Account, as I mentioned, is similar to our PAR type fund, and we'll go into that in a minute. And we also have the Sun Life MFS US Equity, Global Equity, and the BlackRock US and Global Equity type funds. And the reason I point that out is we get asked many times within our PAR account, how much of the assets are strictly Canadian, and it's fairly high. It's about 90% of the assets within the PAR fund, and most typical PAR funds within Canada are managed the same way. Are Canadian assets. So within Universal Life, it does give you some opportunity to get more global and US exposure if that's something that a client is interested in. It is available through the Sun Universal Life offering. So the Sun Life Diversified account, we just did a compare to the PAR account. Very similar, as I said, all the same type of asset classes are available. A little bit more fixed income within the Sun Life Diversified account, but it is the exact same portfolio managers that manage our PAR account are managing the Sun Life Diversified account as well. So it gives that option within a UL plan to choose a PAR-like fund to invest in. That's very stable. The crediting rate is based off of the smooth returns of the yields of the Sun Life Diversified account, very similar to how a PAR account dividend scale interest rate is set. And the crediting rate is guaranteed to never be negative. So there is kind of that floor guarantee on there, which it can be really appealing for clients as well who are looking for that stability. We also have the MFS funds, as I mentioned, one of the longest standing asset management companies in the world. And it's kind of been credited with pioneering the mutual fund. So a really great option as well if clients are looking to kind of get that global exposure. You can see here the rates of return over the last number of years and since inception are very high. So it is an option if clients are interested in sort of looking to diversify a portfolio within a universal life product. As well, we have the BlackRock Equity Index available. very strong performance over, since inception and over the last number of years. It kind of mimics and tracks the US S&P 500. So it's very closely correlated to that. We see the returns almost completely correlated to that index. So another great option for clients who are looking to diversify and have some, different flexibility within their plans. We often see that clients will set up the Sun Life diversified account or a diversified account like that, depending on the carrier that you're with, to cover off the cost of insurance because it's very stable. You're not going to see the fluctuations in it, and then any overfunding can be put into one of these types of funds, so an equity index or one of the MFS funds or one of the other market-based funds to get that exposure for the potential of higher growth within the plan. So that is a very common way we see, and it kind of creates almost this guaranteed scenario where your cost of insurance is covered. And you could even illustrate like a diversified account at 0% if you wanted to be ultra conservative, which would 100% guarantee that your cost of insurance is covered. And then any growth on top of that would be illustrated through sort of the market-based funds. So a very common way to set it up. Okay, let's get into a quick case study. I always like this quote. We tend to make all of our financial decisions based on our opportunity costs, just like they teach in freshman economics. And I think there's different opportunities, to use that word again, and to set things up a little bit differently and look at things from a bit of a different angle. So we wanted to go through a case study. So this was for a female age 65 who was a corporate business owner. She is a holdco with 15 million in cash in it and doesn't really have any need for liquidity or leveraging, is really looking to maximize that death benefit down the road. So this is an estate play. It's not really to have the flexibility to pull money out in this case. They really just want, have a need at the time of their passing to make sure that they've maximized their estate and minimize tax. And they really want to pay it off sooner than later. So that was some of their goals. So common recommendations we'd see: option one, they could do investment only. They're going to face double taxation of capital gains tax and dividend tax. We would assume an investment earns about 6% a year. Option two, they could buy par insurance with a capital dividend account to help increase the net to estate value and invest the remaining cash. So in this case, we did a SunPar accumulator. So this is our higher upfront cash value product. We did a current dividend scale -1 with a total premium of $10 million over 8 years, maximum overfunding, and $15.5 million death benefit. So if we look at the investment only, you're going to see an investment balance of about 27 million. The fair market value at age 85 is going to be that 27 million. But when you take off the tax, the capital gains and the dividend tax, you're looking at about 22.2 million of that. Now, they would get the refundable dividend tax on hand credit of 7.4 million. So that leaves their net to estate at about 12.2 million, which is an effective tax rate of about 54.8%. Not a great scenario for a client that feels like a lot of tax that they're having to pay out. So what does it look like if they do the par option? So that's where they bought the par policy and they had an amount go into an investment as well. So they're looking at 19.5 million in death benefit at age 85. They got a capital dividend account credit of 15 million, and they got an investment balance of 9 million. So the fair market value of their holdco at age 85 was 22 million. From there, because it's a participating product and it's a death benefit that's getting paid out and will go through the capital dividend account, you're looking at a reduction in the tax down to about 12.7 million. Now, their refundable dividend tax on hand credit is less, just given that it's a insurance product. So you're going to be about 2.5 million there, but it does boost up their net to estate to be about 18.3 million. So 35.9% effective tax rate. So there's a couple of options that you would have to be able to set this up, where you're going to be able to eliminate that tax in a much more efficient way. Of course, accountants are going to want to look at being able to eliminate the double taxation portion. So there's two options that clients have. There's the loss carryback method, or there's the pipeline planning method. So it really, loss carryback is going to eliminate your capital gains tax, and pipeline planning is going to eliminate the dividend tax. So it will depend on the client and the situation they're in of what will make the most sense for them. And we'll just walk through a couple scenarios really quick. So for the loss carryback, we kind of discussed this a little bit, but essentially the deemed disposition of the shares are going to trigger a capital gain over the adjusted cost basis of the holdco, which is a notional amount, usually small. We kind of assume that it's zero. So after death, the shares transfer to the estate, and that's the problem with the cash value product as well. The cash value at the time of death is deemed to be disposed of immediately before death, and they become shares to the company. So that is where a problem is with a corporately owned life insurance product, and how we try to get around that. So after death, the shares, you would transfer to the estate. The ACV of the shares are now equal to the fair market value. Now the estate is in a position of shares with an ACV equal to the fair market value. The corporation would then buy back the shares from the estate and cancel them. This creates a capital loss to the estate, and the capital loss is equivalent to the ACV and the fair market value of the shares. The estate is also deemed to receive the taxable dividend equivalent to the fair market value of the shares. Now, provided that the estate acts within the first year following death, they are allowed to carry back that capital loss to the deceased terminal tax return. However, the Income Tax Act only allows the estate to carry back the full amount if the estate implements the 50% solution. So that's 50% of the fair market value is paid from the capital dividend account, and 50% is subject to dividend tax, and that's kind of that 50% solution. That could change given that the capital gains inclusion rate has changed, and so that could be altered a little bit. It would be more like 67% tax at this point. So the result from the loss carryback method is that the capital gains tax has been eliminated, but the dividend tax still remains. So then it would be distributed to loved ones as a dividend to shareholders. So if we take and layer that on now to our previous solution, so the top few rows are the same, looking at the fair market value. The total tax and capital gains has been reduced from 12.7 million to 9.2. The refundable dividend tax on hand remains the same. So it's increased your net to estate to 21.8 million and reduced your effective tax rate to 23.7 million. So quickly, we'll take a look at the pipeline strategy. First step is the same as the loss carryback. The owner of the holdco passes away, and a capital gain is triggered from the deemed disposition of the shares immediately before death, and then they're transferred to the estate. And now in the pipeline planning method, we're not doing any of the capital loss carryback to get rid of the capital gains. The estate actually creates a new company, and the new co buys the holdco shares from the estate at the fair market value. Of course, NewCo doesn't actually have any cash because it's a brand new company, so it doesn't have any assets or anything. So it's just issues a promissory note. So it's really essentially an IOU to the holdco. And then because the estate the estate then merges with the holdco into one, and NewCo now uses the money it received from liquidating holdco to pay its debt, to pay the IOU to the estate and cancel that promissory note. The payment of debt is not taxable, so there's no tax on that transaction. And now, because NewCo has no assets and no reason to exist, it can be dissolved with no tax consequences. And then they would distribute to loved ones free of tax. So they've got rid of that dividend tax that they were paying. So if we look at the par with pipeline, you don't get that refundable dividend on tax because there's no dividend that's being paid, but it does now increase your net to estate up to 23 million because that that dividend tax has been reduced. But you're ending up with an unused capital dividend account credit of 8.5 million. So kind of a less efficient way to do it. There's got to be a better solution. And so we looked at doing a universal life with level death benefit, YOT age 85, with zero cash value life expectancy, with 5 deposits, using the Sun Life diversified account at 3%. Just quickly, we had our actuarial team pull together a few scenarios of where we could see the Sun Life diversified account crediting rate go in the future based on different scenarios. And even if we look at our worst case scenario, which was equity and real estate returns reducing by 2% for the next 10 years, we're still only looking at not even quite 100 basis point reduction. So if we take a look at the graph, the grid on the left, those amounts are very small between each line. So we're going from 4.1 down to about 3.1 or above, just above 3.1% in sort of our worst case scenario over the next 10 years. We're very likely we could see it more levelize off, and maybe a slight reduction in the next 10 years or so, depending on what happens with interest rates. But we could see that go right back up again. So again, just that stability that you can get within the Sun Life diversified account. So if we look at that scenario now, and we use the pipeline planning just because it's the most efficient for our case that we looked at, you're going to have that 9 million in investment balance across the board, regardless of which life insurance strategy you use. But your death benefit's going to be higher because your cost of insurance is less. So you're getting 24 million in death benefit. Ultimately, with the universal life without pipeline planning, you're getting 26.5 million, and reducing your tax rate to 22%. But if you implement that pipeline planning, you're really getting that down to about 12%. So really great option for clients who are looking to sort of maximize the estate value. And just quickly, universal life does have a higher death benefit and capital dividend account credit than par. Typically, at almost all durations, there might get a few years. In this case, this was for 65-year-olds, where in their early 70s, where par might have a slightly higher death benefit and slightly higher capital dividend account. But for the most part, your universal life is really going to be the key winner here. And I know we're getting close to time and wanted to leave a couple minutes for questions. So, a lot of times we hear what's the catch, or where accountants are going to ask. And really, that's where you need to explain how the pre-funding, so doing that higher upfront funding and YRT and how it works, and making that clear to an accountant that it really is key that clients need to be committed to the policy and paying those higher upfront costs in order to ensure the funding happens appropriately. And then just quickly, I'm going to just highlight a quick offer that we have going on. So from October 15th to December 31st, any client that purchases a non-par permanent life or universal life policy can be eligible for a 4-month premium discount. Policies have to remain in force for a year from the policy start date, and we will send out a check at that year point for the 4-month premium or cost of insurance refund, and an amendment will follow at the same time. So really great option for if you have any clients that are looking to get into the permanent or universal life space, they can take advantage of this offer until the end of the year. I think I will stop there and pass it back to Jonathan and take any questions if there are some.
Great session, Catherine. No questions yet. We'll kind of wait a second just to see if anything comes in. And in the meantime, Catherine, I'll just say great presentation. I really appreciated seeing the real life examples where UL was a great fit for the client given its flexibility. It's also nice to look back at the trends over time and just to see how the product mix has shifted with the changes in interest rates. So thank you so much for that. To the folks on the line, make sure to speak with your local Sun Life representative if you'd like to learn more and to help with any of your UL illustrations.
Wonderful. Thank you so much.
You're quite welcome. Thank you for joining us. Will the slides be available for review? There's a question. I'll take that one and say yes, they will be available. PDF of the slides as well as the recording will be available in the WIN Big website in a few weeks following the sessions. We'll send a note out when everything has been posted. Very clear presentation. Awesome. Yeah, so that's great, Catherine. Looks like we're all set. And thank you again for joining us.